Let's get started by asking our esteemed panelists to introduce themselves, give a little bit of their background. Maybe Charles, we'll start with you.
Eclectic background. I don't normally give a full recital, but I will today. I started out in engineering in the space program as a mathematician and got into venture capital and with John Diebel and Associates and migrated into foreign exchange at Citibank and then Drexel Burnham, where I was overseeing trading in Europe, the market making business, as well as their proprietary trading in Europe, not in New York or LA. And then I became president of Chelsea Bank, New York City, Latin American branches, 16 billion footing, and met Lee Hennessee, who was at the early, and by the way, I was reminded of Lee very much by the prior panel, so I applaud you women for elevating the unconsciousness of us men. So met Lee Hennessee, and she had this little hedge fund index, and she was doing institutional trades with high net worth individuals and pension endowments who wanted to get involved with hedge funds, but hedge funds in those days weren't allowed to advertise. They couldn't go on television. They couldn't have their name in the phone book. We had phone books in those days. And so they were kind of a stealth asset class, and she had the phone numbers and the names and the relationships with a dozen hedge funds. And my bank was struggling to compete with the local banks in New York City and in Latin America because they were going into mutual funds, offering mutual funds, and having my background in hedge funds, or Drexel Burnham was a hedge fund, Goldman Sachs a hedge fund. I said, I'm going to offer hedge funds instead of these mutual funds. I met Lee, and she had the phone numbers, and we got together. My board approved offering hedge funds to high net worth individuals in my bank, and we got married. And so we started the Hennessee Group, which began initially as a fund of funds, which was Lee's kind of thing, and I oversaw that. And then I had a long-short equity hedge fund with a macro overlay, and left the bank, of course, joined Lee. We started the Hennessee Group, LLC. A lot of people say, why was it Hennessee Group? Why didn't you have Gradante in there? And I told Lee, I said, there are two kinds of people on Wall Street. You have the Irish, Merrill Lynch, and you have the Jewish, Goldman Sachs and Bear Stearns. You don't have Italian firms, so there's going to be Hennessee Group that sells, and that's the way we're going. So sold the business in 2015, but kept a small portion. A lot of the investors in the hedge fund side wanted to stay with me. I didn't want to manage more than $200 million. And I have a $200 million hedge fund with a macro overlay, and when it goes to $300 million, which it hasn't gone to $300 million lately, I give back 100 and get back to 200 so I can do it by myself. Anyway, so that's my background. On my way to the forum today, I had a conversation with a friend of mine. We're talking about volatility. A stock could be down, the market could be down 2-3%, and then up 2-3%. The swings are phenomenal. And everybody here knows that the computers are playing a big role. Algorithms is a big word now, but I hear that 60% or more of the trades are algorithmic basis. D.E. Shaw, Citadel, and people like that have a lot of trading going on. And I was reminded, and this is pretty much a retail question as well as institutional. I was reminded of '87 crash when the market was down 20-some-odd%, I think 22 or 25% in one day, which many of you have not ever experienced that in one day, not in 6 months like we did last year. And one of the culprits was program trading, computer trading. And there were other problems too, like Greenspan increasing interest rates dramatically in '87 out of fear of inflation, which never came. But the end result of that was the uptick rule that the SEC instituted to prevent computers or manual traders from just shorting, press to short, press to short, press to short. And the uptick rule required that the stock would have to tick up before you could resume shorting. And that rule was in existence until the early 2000s, I think, I forget, when we went to decimals from fractions. And then it disappeared. And I don't know why it did, and I've been trying to find out from friends of mine at the SEC, and it's really a very vague issue. But right now, you can short, you can press to short. We have circuit breakers in the market. You know, if the shorts are driving the market down too much, they can shut down trading in the entire market or in a stock. But I think that's kind of a poor way of handling the psyche of people by just shutting out the lights in the market and saying we can't trade in this stock or we can't trade in the market until we correct the imbalances. I'm in favor of putting back the uptick rule. So I don't have anything more to say about that other than that. But pay for order flow. When this came about, I was reminded of directed commissions, soft dollars. I guess you're all familiar with that. It's not as pervasive in the marketplace as it was years ago. It originated with the pension funds who saw that their brokers were making tons of money with market makers on the trades. And pension funds were the largest owners of stocks then. Now they have some competition from institutions, but they were the largest holders of stocks. And so they wanted to initially get deals on their commission flow to lower their commissions because pensions have fiduciary responsibility to have best execution at the cheapest price. So they started negotiating deals. And what came out of it was we don't want to rebate back to you hard dollars. In other words, the market makers and the brokers, the agency brokers, didn't want to rebate back hard dollars because that really shined a light on conflicts of interest. But they had a soft dollar arrangement where the pension plan would say direct the soft dollars to a research firm that gave the pension plan research, and their research bill was paid for by these soft dollars. Well, pay for order flow is something like that. It's just a little different twist. I think you all know basically what it is. Robinhood was the forerunner of this. The subtitle of my speech might be Pay for Order Flow, the Rise and Fall of Robinhood. But it's basically using the commissions that are generated by the execution of a trade for the benefit of another party. And in this case, it would be Robinhood and E-Trade, and Ameritrade, and Charles Schwab are the biggest users. Fidelity, as far as I know, is not, and there's a big debate between the users of pay for order flow and the non-users as to what is the most effective way to service the retail client base. Institutions have the best execution by far, and there's no debate about that. They get the midpoint. 60, 70%, most studies show that institutions get the midpoint on a spread, whether they're buying or selling, 60, 70% of the time. No one really knows what the retail investors are getting, and I would venture to bet if they did a real thorough analysis on market orders, you know, they're getting the bid on the buy and they're getting the offer on the sell. So the retailer trades are not being executed as proficiently institutional trades, in my opinion. And so let me get into some of the issues here. I have my PowerPoint presentation. Obviously, the goals of trading, whether it's pay for order inch flow or whatever, is execution, liquidity, and a level playing field. Those are the three goals that the SEC and other regulators are trying to achieve in whatever method they're using to execute trades. The market makers that are the big three is Citadel, Susquehanna, and Virtu. And the issue becomes, is that enough market makers? And the SEC is evaluating this right now as we speak. The agents for the retail trade are your agency brokers like Robinhood, Charles Schwab, and E-Trade. Now, key concerns. Are retail trades getting midpoint of the spread in the pay for order flow? And I can't statistically say they're not, but my gut feel tells me they're not. And I think that's something that I hope, I know the SEC is looking at it, and I would be concerned what they come up with. It just stands to reason if you put in a market order and your retail trade and you're buying 1,000 shares, it just stands to reason that the automated execution of that is going to go to the lowest data point. So, whereas if you're an institutional trader with 100,000 shares, you're more likely to get the midpoint. Conflicts of interest. Citadel was up 38% last year. By the way, very few hedge funds. I know David Einhorn had a great deal a year shorting the market, a few other guys, but most hedge funds had mediocre years, and even the big ones, Bridgewater and so forth. Citadel up 38%. Now, I'm not proposing there's anything of any impropriety going on there, but I think it's something to look at when you have a market maker that has a division that's a hedge fund, which is called the Wellington Fund. And the Wellington Fund's up 38% in a year that was my most difficult year. I mean, I knew to short in 2008, and I knew what to do in the lost decade between 2000 and 2010. When long-term capital hit, that was a no-brainer. In 98 and 94, when Greenspan raised rates, that was a no-brainer. Last year, it wasn't a no-brainer for hedge funds. You didn't. The information flow was schizophrenic. It was a schizophrenic market, and it was impossible to really get a good feel for the market and really hit the bid. So they're up 38%. And they're not revealing even to the LPs exactly how they did it. I'm not saying that is wrong. Most hedge funds don't reveal the underbelly, but it would be interesting to find out. You know, if I was running the SEC, I would say, hey, you know, you guys did very well. Congratulations. Let us understand, you know, how you did it. You got these guys. Now, this is not uncommon on Wall Street. On Wall Street, you have investment bankers who are on a different floor as proprietary traders. And for the longest time, there was suspect that the bankers talked to the proprietary traders about what deals they were doing. I mean, when they went to Harry's, have a beer, I mean, it was just, who wouldn't? So they had this Chinese wall thing. And so the Chinese wall has been an acceptable way of ensuring that the bankers aren't talking to proprietary traders. And I'm sure Wellington hedge fund of Citadel has got a Chinese wall with a market-making business. And I don't know what they do when they go to Harry's or the equivalent of Harry's, but it remains to be seen what comes out of that.
Charles, can we put a pin in that? I just want to give a chance to our other panelists here real quick. We'll come back to that.
You want me to go home?
No.
All right.
Just want to give a chance to Jason and Jeff to weigh in here.
Well, I suggest you extend this because we're having a good time.
That sounds good to me.
I see smile. Even the women are smiling. You know.
I'm just happy you mentioned Harry's.
Yeah. All right. Yeah, Harry's 2.0 is back there. So the next issue is payment for order flow. Did it change the playing field for retail? The best thing I can bring up is Robinhood. I don't think Robinhood has done wonders for Wall Street nor for the retail investor. By their inept management of their balance sheet, they failed to meet DTC's requirements to settle their trades that their clients were executing. The millennials, most of their clients are millennials. And you had that GameStop fiasco, which I spoke about last year. So the question becomes, who is Robinhood's client? Is it the market makers, Citadel, Susquehanna, Virtu, where they're trying to generate trades sufficient to generate revenue? 72% of Robinhood's revenue comes from pay for order flow. That's a very large percentage. So if some entity is feeding 72% of your revenue base, is there a conflict of interest between you and that entity, the market makers, of which Citadel was the primary, and your clients, the retail investor? And we all know the failings of the human being, and I think that is an area that needs to be looked at. We know that Robinhood was set up like a casino, so I'm not so sure this pay for order flow, zero commissions, where you can go in and sell 100 puts on XYZ stock, turn around and buy 100 calls using the put money to buy the calls, and then closing out the trade in day one before or shorting a stock and then closing out, naked shorts. So I think there's a lot of incentive with zero commissions to over-exaggerate your trades, and especially among millennials who didn't really understand the dynamics of their call buying and what it did to the settlement function. And also the offset to a long call is a short call that was held by Citadel, and they would hedge that by buying the stock or another call. Some positives about this pay for order flow is that it did consolidate a lot of trading at the big three, Citadel, Susquehanna, and Virtu, and the more volume that went into these entities, the greater the liquidity. This stands to reason that their business is to match a sale of a security with a buy. And so if you have three players, you're going to have greater matching, quicker, and more fluidity, and not using the capital base of the market maker as much as you would ordinarily do when you don't have great order flow. Okay, the market maker puts his own capital at risk. So that was a benefit. Spreads have narrowed, but largely due to the decimalization of trading. We used to trade in fractions, so 1/16 was about the lowest fraction I ever traded, and the decimalization opened up this whole digital world in trading. So those are the benefits. Execution is faster, but the issue becomes what execution is the retail getting, and I don't think they're getting the best execution. There's a big debate between Fidelity, which is not part of the pay for order flow. They say that their retail investors are getting better execution than those that are in the pay for order flow. What's next? Well, the SEC is addressing this issue. I feel there's a need for increased transparency. When you do research on this issue, there aren't many statistics. There was a study done by the University of California that supported pay for order flow, but we're not sure where they got their financing from in order to do that study. But the good news is Gary Gensler, the SEC head, is very suspicious or very skeptical, not suspicious, very skeptical of this whole process, and he wants to redo the equity trading platform. And I believe they should go to an auction system, and where these market makers enter a pit and they have an auction to pick up a trade. And that would eliminate a lot of the bias in this field.
Okay, that was a mountain of knowledge. Thank you, Charles. Jason, please give us your perspective. You want to weigh in here?
Sure. Thank you. Thank you, Jarrett. I'm just very proud that you called me esteemed. Thank you very much for that. So I think part of what we were looking at was talking about meme stocks and retail holders, and kind of wanted to just bring up a little anecdotal case study from case study. It's not that thorough, but last year we were involved in a situation. So for background, I work at Okapi Partners. We are what we call a shareholder response firm. We do proxy solicitation, proxy fights, M&A situations, and help people understand investors and investor behavior. So in this situation we were involved in, we had a private equity client that was buying Houghton Mifflin. Definitely not a meme stock, not a sexy company. They did digital publishing, educational publishing. Deal was offered at 21. Right after the deal was offered, you had 3 dissident investors come forward and say, hey, that price is not good. We think it should be 28. Well, the deal launched, the tender offer launched, and the trading, obviously jumped up, but stayed below the offer price, which is very typical for where we were. But then we started to see some unusual, about a week and a half before the deal was to expire, we saw some unusual activity. The unusual activity was going on in the options market. We saw the amount of calls that were being sold start to increase dramatically. And that's pretty unusual when you're looking at a company that's going to go away, for people to start buying calls 1, 2, 3 months out, and with a strike price of $22.50, which was way above. Now, the dissident had come out and said that this deal should be 28. That should be the price. So you can understand that, but they didn't seem to be getting a lot of support from the traditional institutional players. The traditional active players really weren't buying that price. So we started to do some research on this volume, and what we found out was that the Reddit group, the Reddit gang, had gotten involved, and they started posting and advocating that their followers start buying calls. And the interesting part then was we saw the actual volume on the regular shares go up, because a bunch of ARBs seized on this opportunity and started buying shares and then writing calls against the shares. So they were basically making the bet that the deal was going to close, and they were going to hang the retail population, and all the buying on the calls was on the retail side. We didn't see a significant amount of buying from institutions. We didn't see the ARBs weren't getting in on that side. They were getting in, and they were writing the calls. So when everything came down to it, the problem for us as working on the deal were we saw about 10% of what we would have expected to tender into the offer not come in, because due to compliance issues and not wanting to expose themselves, they didn't want to tender to the offer, so they had to hold back. But when the offer expired, we had about 55% of the shares came in. OCC collapsed the contracts. So they were pure profit, and they were going for, it was like 25 cents a call. And so they made a significant amount of money and basically reverse GameStop the retail crowd and kind of hung the bag on them, and were able to profit significantly from that situation.
Okay. We are seeing retail investors get more and more sophisticated. Jeff, tell us about your company and what about meme bonds?
Yes. So our company is Goodfill, LLC. We're approved as a FINRA broker-dealer. We're launching a corporate bond app for retail investing next quarter. And so, the topic is meme stocks and beyond. We're definitely the beyond. So, we spent a lot of time with regulators saying, look, we're not trying to gamify bond investing. This is essentially sort of the 40 and the 60-40 portfolio, right, for the rainy day money, et cetera. I think even meme stock traders in many cases have some savings. So, backing up even from corporate bonds, then the question is, what do people do with their savings now? So, I think everybody knows that the bull market of the last 10 years, largely liquidity driven anyway. So everybody's very focused on rates. The curve's inverted now. The Fed owns $8 trillion of bonds. So yeah, the curve's inverted, but if the Fed decides to unwind some of their bonds, that curve could uninvert pretty quickly. So, there are a lot of dynamics happening there that I think everybody is focused on. It's affecting tech valuations, et cetera. So, in terms of what people do with their savings, well, you can put it in a money market fund, right? So, the 1-month bill is 4.5. Money market funds pay maybe 4.25, right? So they pay you less than the government rate. They have expense ratios a quarter-ish. So you can do that. Plus, it's all taxable as ordinary income. So, if you're an individual, back to the meme stock folks, if you're an individual meme stock person and you're just punting, then, your gains, when you knock it out of the park on your 10-bagger, that's ordinary income if it's held for less than a year. So if you live in New York or in California, you're paying a 50% tax on that. So, I'm not sure how many of these folks, who have, bought the call options and, out of the money and whatever, GameStop, I don't know how many of them have gotten their tax bills yet, how they're working that. So, if you just invest short dated and clip coupons, then you've got a big tax bill. So, the other side of it is, well, you can invest in bond funds, right? So, retail investors now have $5 trillion in bond funds, basically mutual. Most of it's mutual funds, 90%. ETFs are very big. So, what happened? What's a good, safe mutual fund, right? Say, Vanguard's VCSH. So, 2.6-year duration. Corporate bonds. Super liquid, very safe. So, what has that done? It's a 2.6-year duration, and compared to 2.6 years ago, the price of that fund is down 9%. Okay. So, investing in a 2-year bond fund does not mean you get your money back in 2 years. And in theory, right, if the Fed keeps hiking, if there's another war, if there's more inflation, more wage hikes, et cetera, big 500,000 job numbers, it's, series of those, in theory, you may never get your money back. So, right, how do you invest in something if it's rainy day money, right? If it's, money that you want to be pretty comfortable you're going to get back in some predetermined time, how do you manage that? So, one nice thing about the interest rate increases that have driven down prices of bond funds, et cetera, is now there are quite a few bonds that are trading at deep discounts. So, I think Jarrett started off with, hey, what's a meme bond? And, I had to think about that a little bit because, we're not gamifying, there's nothing fun about fixed income. But, for instance, if you go out 2 years, there are a couple of bonds. There's one issued by Toyota. There's another one by TD, 5% yield, okay, and a dollar price of 90. So, what that means is in 2 years, let's say, you're a meme stock person who has said, okay, I'm going to be a little bit smart about my tax situation. I'm going to hold on to these things for longer than a year. Okay, then they're long-term capital gains. So again, right, California, New York, your tax rate goes in half right there. And so, that's fine, but let's say, maybe 1 or 2 of your meme stocks don't work out. And I'm pretty sure if you're an active meme stock trader and you win on all your meme stocks, you may not be Citadel, but you're going to get some calls from the SEC, okay? So if you have capital losses that are longer than a year, then it can take some of the sting out of those losses to be able to say, hey, in 2 years, I actually have a capital gain of 10%. And all that has to happen for that is for Toyota or Toronto Dominion to give you your money back in 2 years, right? You think you can be pretty confident in that? I do. So if that happens, then you have a 10-point gain that you can offset, and all of a sudden your 10-point gain, if you have meme stock loss of that amount, it's tax-free. So, things like that. It's not so much about, do we do it on an app, right? So, yeah, people can go into their electronic brokerages now and sift through, all the bonds. And, really what happens now is, corporate bonds have been kind of an afterthought. And so, it takes a while to find your bond. Let's say, you want to see bonds from TD. You probably get a list of 300 bonds. And, some of them have been partially tendered or partially called. They have like 10, 20 million outs, just all kind of cats and dogs. And so, how do you find the issues that are liquid? Because liquidity is key. And I think, Charles early on made some great points, right? It's about liquidity and it's about execution. So, one nice thing about the corporate bond world, and anybody who's been involved in bonds has seen, is all the electronic trading and all the different ECN, market access and TradeWeb and bonds. There are like a million ECNs. They all plug into each other. It's not like the NYSE or NASDAQ, but, the go-go issues, they have consistent bid offers small size, 2 or 3K is fine, because what happens is the big dealers basically just stream the quotes, right? Everything under $2 million for a top 5 dealer, it's not a lot. They don't even, trader never even sees it. Just puts it on the machine, goes straight through. So you're going to get the bond you want, at the offer price. You're going to be able to sell at the bid, and that bid offer is pretty reasonable. So, the dynamics have changed a lot. The interest rate environment's changed a lot, and, tax situations, et cetera. I think, when you look back and say, what should I be doing with, the antidote to my, meme stock that doesn't work out, then, we just kind of offer up, how about corporate bonds, basically?
All right, great. Charles, I want to go back to you. In addition to your proposal about the uptick rule, you also made a proposal in Congress about the gatekeeper rule. What happened there? Can you tell us more?
Well, that was directed at. Am I on? Yeah, that was the
gatekeeper rule.
Gatekeeper rule. Hedge funds have had a history of fraud, not pervasive, but enough to tarnish its reputation, especially in the 90s and the beginning of the century. And I was summoned by Congress to give my opinion on things, and I told them that first of all, there'll always be people in the fringe trying to game the system. But we need to have gatekeepers take some responsibility. And to the best of my knowledge, none of this has been done since I mentioned it in 2002, I think, 2004. One is the accountants for hedge funds. Unlike in the corporate world, where the accountants report to the board of directors and indirectly to the shareholders. Shareholders do vote for the accounting firm. In the hedge fund world, the limited partners have no say on the accounting firm and can't even call up the accounting firm to verify that the document they have, the financial document they have, is in fact their document. All they'll say is, we signed it. Do you see our signature? Yes. It's our document. If you have any questions, speak to the hedge fund manager. The issue with that is, in this day and age of being able to convert a Word document or a document into a Word file and then changing things, you really have to get into some of the numbers, maybe not all the numbers, but some key numbers to verify that the report you have is in fact a legitimate report. Now, I'm not suggesting this for the big hedge funds, but the small hedge funds, 50 million, 100, up to about 500 million, they're susceptible to manipulating the accounting firm, and if you're going to have another fraud, it'll be in that kind of dimension. The second area was the prime brokers. A lot of the small hedge funds have a single prime broker, and the prime broker is supposed to receive the financial report of the hedge fund every year, and there's very little to no reconciliation. Many frauds in the hedge fund world could have been caught by the prime broker if they would have looked at the financial report and said, this doesn't jive with the trading we're seeing. Obviously, those hedge funds that have multiple prime brokers, it would be difficult, but the administrator can perform that function, collecting key data, not everything, but bits and pieces from the 3 or 4 prime brokers they use, and sort of giving it an acid test. And the third, and my pet peeve, lawyers, I know we have lawyers in here in the room, but there are offering documents that hedge funds put out, and this comment is not only about hedge fund documents, but most other documents in the asset management world where you have resumes. Now people invest on performance, and they like to see a good resume. So the resume is it's like a job interview. If the resume says you went to Harvard and you were a head trader at Goldman Sachs, that's impressive. Yet lawyers they're not responsible for validating the resume they put into the document. And so consequently, the investors take resume risk that the lawyer could offset one time, verify the college, verify his employment history. Was he the head trader? Did he go to Goldman? And that relieves a lot of pressure from the investor. There have been many resume frauds, and I even think now with this SBF, I think you're going to find that the information in his offering docs were a little bit short of real. So that was something that is still a pet peeve of mine, along with the uptick rule, and I'm glad I got it out.
Great.
Maybe they can do that for Congress too.
Yeah, as you can tell, I'm outspoken, so they wanted to hear an outspoken person. But the problem is, if you're outspoken, you'll get called to testify, or if you use the word testify, I was not, indicted. But you get called as an expert witness, and the thing is, it falls on deaf ears. I just don't understand the half-hearted attempt at purifying the system. But in an effort to make up for that insult, I repeat what I'm saying over and over again. I told them.
All right. Do we have any questions from the audience? We're happy to take any questions if you have any. Yes.
This is for Jeff. Yes. So Jeff, I started my career in fixed income, and I remember sitting there thinking, isn't it weird that no individuals own any of these bonds? I did this huge tender offer thing with Sears. This is I'm dating myself, 2004.
Yeah.
And I understand that there's not, I guess there's not an easy way to do it. You can, right? I could go to Schwab or Fidelity and say I want to buy some forward bonds, right?
Yeah, just not on your phone. Don't try to buy it on your phone. You got to type in a QSIP, basically.
Yeah, I remember, the smallest number of, any of those issues owned was, tens of thousands of bonds. There's no retail element. Is it starting to change?
No, I don't think so. So, 10 years ago, Americans, retail investors owned $1.5 trillion of corporate bonds. So there was a time, and I think a lot of them were high yield bonds. So, people would kind of normally buy, different types. It was just a thing, probably 10 plus years ago. Now, that's down 90%. It's less than 200 billion. So, people have really pulled away. Meanwhile, ETF investments and mutual fund investments, right? Those have picked up quite a bit. So people see, the tagline for the ETFs is low fees, high liquidity. But, the liquidity, it's a double-edged sword because, right, like we talked about, a 2-year fund, it's always a 2-year fund. So, if you want your money back, and if you want to know when you get your money back, a fund is not the way to do that. So I think, people have kind of, they can buy ETFs on Robinhood. They can, it's easy to do. And, I think also when rates were falling all the time, right? So we basically in a 10-year rates bull market. So, they buy the ETFs, the mutual funds, right? They're making money every year. It looks pretty good. Last 6 months, that has not been the case. And, I think there has been, a huge change and a lot of head scratching, a lot of kind of wondering, what's going on? These were how many people have you heard say, oh, bonds and stocks down together, this is terrible, it never happened once in 100 years, all that sort of thing. So, I think people had just moved away in a different direction and things are different now. Every day, I think, one of my favorite quotes from an analyst that I used to work with was, every day something happens that has not happened in the last 100 years. So, we have a situation today, how do you optimize for our current conditions, really?
Great. All right, well, we should move on to the next one. But, Jeff, I've got to ask you one more thing. So is one of the reasons why some of these high-quality bonds are trading now, is it because of inflation? Because, the real yield maybe isn't as good as it looks in nominal terms?
Bonds, so, bonds trade in a pretty mechanical way, right? There are really, kind of two things that are important to look at for any bond, and it's yield and price, right? So, what's your yield, yield and maturity. So what's your yield, how long do you get it for, right? And, then price is, it's important, but for total return purposes, kind of put that aside, and I think coupon is sort of a footnote to that. But for credit bonds specifically, there's also a risk premium. So, what's it rated, what's the credit risk, and how much are you getting paid for that? So, for any bond, right, government bond, anything, right, it's yield and, it's maturity. So, the simple reality is when yields go up, prices go down. yields go up, prices go down. However, bonds also have maturity dates. So, yields can go up to 20%, right? But if you bought a 2-year bond 2 years ago, say from the U.S. government, right? You bought a 2-year bond 2 years ago, and today is the maturity day. Yields may be 30%. The government still has to give you your money back. You're going to get back principal. So, there's, bonds, they're super mechanical, but, you have these situations where all of a sudden, really even treasuries, right? They can trade it. There are plenty of old treasuries that trade, short dated in the 90s, low 90s, et cetera. So, that really is just math. But, the question is, how do individuals sort of take advantage of that?
All right.
Sounds like there's a real lack of understanding, there's a lot of in-depth, and maybe it's not that difficult, but...
Yeah, I think if you focus on just the main points, it's not that difficult. It really, it's, yield and maturity. People I think one great example of, a very successful app actually has been Robinhood, Marcus. Right? So Robinhood's on meme stock. So Marcus is Goldman Sachs. I think a lot of people have heard of that. $100 billion under management. And they pretty much have one product, and it's a Marcus CD. And you can get a 3-month one, and you can get a 6-month one, and you get a 12-month, 2-year, 3-year. But, it's only a Marcus CD. And, they pay around the government bond rate, but not too different. But they have a nice app. You can kind of flip through it, et cetera, and it's convenience. So, there are lots of articles about this. Why are people not, moving into different instruments? Why are people keeping their money in CDs? Because it's just kind of a headache. And, I think, again, the simple math is very straightforward. It's just the access. So, how do you find the right bond that's not, one of 300 little scraps, right? How do you, kind of look at what you need and just, be able to focus on the key points? I think it's, the numbers are pretty simple. It's just been kind of a confluence of things. And, we often thought why doesn't Robinhood offer bonds? I mean, they've got 20 million funded accounts, $100 billion management, just put bonds on their platform. But it's not cool enough, probably, right? It's not part of, right? Wall Street Bets, is anybody going to write about, 5.5%? It's not their kind of thing. So, people might do it at some point, but we haven't seen it. So.
All right. Well, thanks a lot. So I think what we're going to do, folks, in order to try to keep us reasonably on schedule, by the way, thank you, everyone. We're going to move on to the next one. But, gentlemen, that was terrific.